Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Rise of COVID-19 cases, concerns over lockdowns and stimulus, and the risk of Washington gridlock, assuming we would not get a blue wave, are spooking the markets. Joining me to discuss is Eddy, Augsten, Investment Committee Chair with Concurrent. Eddy, it's great to have you with us. Welcome to Trade Talks.
Thank you for having me, Jill. I really appreciate it.
You got it. And looking strictly through a market lens, where do the election risks and opportunities lie?
Well, Joel, I think in your opening remarks, you laid it out pretty well. The market is certainly spooked. I think today's a better day, but last week the S&P gave up 5.6%. Year to date, the S&P was still up about 1.2%. But that came really off the back of a good 6-7 weeks of a market run that was anticipating and really following the polls. Right, the polls were telling us that Biden would likely win and that we'd have a Democratic sweep. I think last week, as the polls start to tighten, especially in divisive states, right, like Arizona, Pennsylvania, Florida, Iowa, as we saw that, certainly the markets started to get a little nervous. And all of that is really based on the fact that the markets know that we need stimulus. They are looking for the greatest scale of that stimulus. A Biden win, a Dem sweep, means that we get closer to the $5 trillion bill that the House put out in May. And so anything really different from that is uncertainty, right? The idea that that stimulus might be less and the timing of that stimulus now is in question. And so, at Concurrent, on the investment committee and the 100 advisors at Concurrent, one of the greatest things that we have to focus on is really emotions with our clients and the behavior off of those emotions. And so certainly with this election, there's a lot of emotion. It's probably one of the most exciting elections. We can call it divisive, but it's also very exciting for those individuals that are involved in this. And, as we start thinking about how we position portfolios going forward, it's really important to think through these outcomes and what the risks are for each of those candidates. And so it was very unlikely for the market to assume that you would have a Biden win and a sweep. And so last week made a lot of sense because really when you start looking at the formation of the Senate and the 100 seats, the Dems need 3 seats to tie the Senate. And then Harris as a VP would break that tie. But really, there are a number of Democratic senators on the Senate from Republican states that just are not going to toe the Democratic line, right? So a Biden sweep really means 53, 54 seats. And coming into this week and really seeing the polls last week, it just doesn't look like that's really going to happen. So we really have to start focusing on what the risks and the opportunities look like for each candidate and their policies.
Let's do that, Eddy. Let's drill down to the candidate specific risks and investment consideration. What are the key takeaways with a Biden win?
So with Biden, so clearly the greatest concern and the policy that's been out there now for many, many months is all around taxes. And clearly it's one of the most progressive tax policies that we've seen. We know that if you're in the top 1% based on Biden's policy, your after-tax income is going to go down, probably by the low teens. And we know that there's going to be a lot of talk about that policy going into next year with that win. But the most important part of the policy is really around corporate taxes. And that's really what has the greatest effect in terms of stock prices. So corporate taxes in terms of policy, the Biden campaign would be increasing corporate taxes from the current tax at 21 to 28%, which is halfway back to where we were since 1993 to 35. It's also aside for the last 2 years, the lowest tax we've had in the modern era and competitive globally. But there is no doubt that increasing taxes will have an effect on corporate earnings. An effect on corporate earnings is going to affect pricing. Pricing is going to put pressure on stock prices and the stock market. And so we see that as a very clear, logical risk to the markets. But on the other side of that, if you go back to what the election is really about today for the markets, it's about stimulus. It's about the resurgence of COVID cases. It's about a mitigation plan, and it's about how quickly we get a vaccine, how quickly we get that stimulus. And if you take that into account and you think about the fact that we're at a point now where the economy is barely functioning at 60%. We have a service economy that is on its knees. We have service employees that are out of a job. And so the sooner we get to a point where the economy comes back, where the consumer has a reduction in fear and goes back out. I would love to go back out and have dinner, not only with my wife, but with my friends. And if I did it tonight, I'd do it again tomorrow because it's been so long since we've done it. bringing that back into the economy can offset a lot of those risks, because those higher revenues will support and offset some of the risks that we see in the reduction of corporate earnings from this corporate tax cut.
And of course, we have to take a look at the incumbent. What are the key takeaways with Trump?
So Trump, the great thing, so historically in an election, status quo is good. Gridlock is good, right? The market prefers a situation where they either know what's happening, know what's going on, have clear expectations, and or a situation where they know nothing's going to happen, right? That's what the market enjoys. The problem with that is that this time, you hate to say it, might be different. It might be different because we need stimulus and we need it now. And we have this this virus, right, which could become something more than transitory if we don't start to have a mitigation plan and we don't have a vaccine come in place and we don't have this stimulus. And so, you know, with Trump, the greatest concern, aside from what's going to happen with stimulus, really comes on the back of trade policy. And so while we've been so focused on the election, one of the things that's happened is we've really taken our eye off the ball in terms of trade. And the trade tensions are still there as they were in 2018 and 2019. And if we think about monetary policy today, we think about the Fed funds rate. The last time we saw a zero Fed funds rate was in 2008, 2009, coming off of the back of the great financial recession. We saw that zero rate all the way through 2015. And then we saw hikes in the Fed rate from 2015 through 2018. But before the pandemic, last year in 2019, the Fed reduced the Fed rate 3 times in August, September, and October. And they did that because it was more of an insurance policy, which we don't see a lot from the Fed. It was an insurance policy because we were seeing a global slowdown in economic growth. We were seeing the US economy and US inflation under or subpar, and it was all in the back of trade tensions and trade war. And so we then move into this pandemic, which feels like it's been a decade in the making. But if we come back to trade tensions and trade war, that is probably one of the greatest risks that we see coming off of a status quo election.
Okay, Eddie, we have about a minute to go here. What are you recommending to investors as we work through the election and potential aftermath scenarios?
So I really think, you know, check your emotions. You know, don't make any rash decisions. You should be thinking about what the results are going to mean in terms of a rotation or a change in your investment policy. One of the things that we're looking at, if we see a Biden win and a blue wave, is a continuation of the cyclical rotation that we've seen. We'll be focusing on industrials, materials, financials. We'll be a little more careful with regulated industries, so healthcare, energy, tech. And if there's a status quo or even gridlock, we'll be looking at really the opposite of that and more disinflationary environment, more focus on large caps versus small and mid, a focus on mega caps. And obviously you'll probably see a relief rally in a lot of the sectors that are highly regulated like energy and healthcare.
All right, Eddie, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.